Welcome back friends to the class number 48. Now we have cleared all the critical methods of calculations of MPBF. Now we want to discuss something different. We want to discuss what are the problems associated with current ratio, MPBF and net working capital calculations. Although I have already made one video with respect to problem in NWC calculation, right? But there are some other problems as well. As you can understand, all of these things, the current ratio, the MPBF, I am talking about MPBF method 1 and method 2 of Tandon Committee and NWC. All these three topics are associated with current assets and current liabilities. They are somehow connected with these two items only for the purpose of calculating eligibility, right? So what are the problems that these three items have? The number one problem that they have is the inclusion of hard cash and liquid bank balance in current assets. When we compute the eligibility under MPBF or MPBF 1 or MPBF 2, we take current assets in total. Right? Then we take the current liabilities. Right? In these current assets, cash and bank is also included. This cash and bank is a hard cash in itself. This cash and bank balance do not require any funding support from the bankers. When we do current assets and current liabilities calculations, we are essentially saying that these are the investments done by the promoters. These are the funds of the promoter of the business which are stuck up in the current assets. Tell me guys, whether the hard cash and bank balance represents the funds stuck up in the business. These do not represent any blockage of funds in the business. So by inclusion of cash and bank balance in the current assets and by saying that these current assets represents the blockage or investments of funds, we are essentially doing principally something wrong, right? So I hope you have understood the point. So these items are made part of the current assets. They are actually liquid funds. They are not an investment, or we can say that they do not require any funding support or any promoter margin needs. If you remember, in the MPBF method 2, we ask for minimum NWC of 25% of total current assets, which means we are asking for margin of 25% on total current assets, and in a way we are asking for margin on 25% of cash and bank balance as well. Why do we need the promoter margin on the liquid cash balance, right? So this is principally wrong, which is followed by every bank, and no bank has ever thought of correcting the same. The second disadvantage here is the promoter margin calculation is not done. I have already explained to you in previous videos why promoter margin is important in the business. But these ratios do not consider anyway the promoter margin. Suppose the current assets are rupees 100, current liabilities are rupees 50. The difference of rupees 50 represents the NWC. This represents, as I have already told, this represents the long-term funds invested in short-term assets, in current assets. But these long-term funds of rupees 50 can be from outsiders as well. You can take LAP from the bank and use that LAP of 10 years tenure in investing in the current assets, and your NWC will improve drastically and your MPBF eligibility will also improve consequentially, right? But here, by doing this, we are not looking at the actual promoter contribution in the business. This NWC can be due to the long-term funds invested in the business as well. So the ignorance of promoter margin is a main disadvantage that we can see in calculation of current ratio, MPBF and NWC. Current ratio, MPBF, NWC can improve even if there is no increase in promoter margin. As I have already told, you can take LAP of 10 years and invest the amount in current assets or repay the current liabilities. All these three things will improve, right? Whole of their positive calculation, the positive NWC like here 50 rupees, can be due to the long-term funds taken from the outside. So promoter margin calculation is technically ignored, but there is a solution to it. I will be discussing the solution in the upcoming video. Third disadvantage, as I have already discussed in a separate video with you, the short-term portion of long-term debt is treated wrongly by the bankers. I have already explained this point in too much detail in a separate video. So I suggest that you watch that video in order to get clarity over that point. So already discussed in a separate video. These short-term portion of long-term debt are made part of the current liabilities. They are made part of the current liabilities, but their funds are not used in investments in current assets. I have already explained this point in full detail in that video. I suggest you to watch it, right? The fourth disadvantage of MPBF or current ratio or NWC is of uncertain future and lot of predictions. Right? So you are calculating NWC, current ratio and MPBF basis current assets and current liabilities. Now, what does define current asset? How we can say that a particular asset is a current asset and a particular liability is a current liability, right? In order to increase the eligibility, we may classify some of the assets which are non-current in nature as current assets, or if we do any negative biasness, we can classify some current assets as non-current assets, right? So there is a lot of biasness involved in classification of current assets and current liabilities, which may hamper the actual results. Furthermore, suppose you are taking a stock as current asset. A stock is there in the factory and the stock is a current asset, obviously. Now, as a investor or as a lender, you don't know that whether this stock is actual in marketable condition or not, whether this is actually sellable or not. It may be possible that the whole stock is obsolete, or this whole stock is a bogus stock. There is no physical stock actually available in the factory and the borrower is doing fraud with us, right? So we are not technical person. We cannot verify the actual stock or the quality of stock at the premises. We just rely or trust the promoter's confirmation on the same. Promoters confirm to us that this stock is genuine. This stock that we have this much of stock, minimum inventory at all the times, right? So this prediction is also dangerous in calculation of current assets and current liabilities and resultant the ratios, right? And you are already aware that the future is very uncertain. You never know what will happen in the future or not. You are devising the eligibility now, but you don't know what will happen in the future. That is another disadvantage. But one more point that I need to add here: when we calculate the current assets and current liabilities, we take these current assets and current liabilities on the balance sheet date, usually on the audited balance sheet date. So suppose I am sitting on today is 11th of June 2025, right? So I have got the balance sheet of suppose 31st March 2025. So I have got the balances of current assets, current liabilities as on 31st March 2025, and I am calculating eligibility basis that. But 71 days later, around 71 days later, post 31st March, the actual position of current assets and current liabilities could be way different than what it got represented on 31st of March. So this is another untrusty or less reliable thing that we are doing in these calculations. Now the fifth point is a kind of psychological or theoretical point, right? So what is the bank's thought process? Bank thinks that the current assets should always be more than current liabilities, and due to only this, your eligibility will meet. So bank is pushing you hard to achieve this situation of current assets being greater than current liabilities. If you are in this situation, then only will bank consider you good for funding, right? But if we think carefully, the promoters actually think on reverse side of it. Promoters actually want the current assets to be less than current liabilities. Why? Suppose there is stock, there is debtors, the amount recoverable from your customers, and creditors, amount payable to your suppliers. So these are current assets, this is current liability. Suppose these are the only three items in the balance sheet, right? So you have invested amount of rupees 100 in stock, 50 rupees you have given as credit to your customers, and 50 rupees you have got credit from your supplier, that is your benefit, and in nutshell you have invested 100 rupees. So what will promoter want? promoter will want to minimize these 100 rupees investment. He will want the stock to sell quickly. He will want that, he will always want that he need not to carry higher stock in his books of account. He will always want to sell this stock as quickly as possible, right? He will always wish to collect the payment as soon as possible from the customer. He will not be willing to give any credit to the customers if he thinks everything goes as per his choice. But on the reverse side, he will want that creditors should be paid as late as possible. He will want the stock to sell out quickly, so he wants it to be zero. He wants debtors to be zero. He wants this amount recovered as soon as possible, but he doesn't want to pay them. He doesn't want to pay them. He want to pay them as late as possible. So if we go to the choices of the promoter, it is pushing the business on the reverse side. So he wants the current assets technically to be nil or zero. His goal, his dream, I mean to say, he wants them to be zero, and he wants to be as maximum as possible. So if we go by his dream, then there will be negative gap here, right? So ultimately the promoter is trying to achieve this situation, the bank is looking for this situation. So this kind of create a contradiction in books of account, which may result in manipulation of books of account by the promoters in order to get maximum possible finance from the bank as possible, right? So these were the disadvantages that I wanted to discuss with you. I hope you have understood it. In the next video, I will cover the disadvantageous point of not considering the promoter margin in these calculations, and how do we correct this mistake. We will discuss in the next video. Stay tuned with this channel. Thank you very much.